Thank you for joining us for our monthly webinar series from Local Market Monitor, where we take a closer look at this month's National Economic Outlook, which was written by Local Market Monitor's president, Ingo Windsor. For those of you that don't know Ingo, he has been analyzing real estate markets for over 30 years as a graduate of MIT and Boston University. He's not a typical economist and has a knack for taking complex data, extracting what is important, and providing unique insights and tangible guidance on real estate markets. So with that, I bring you Ingo and his insights on the economy.
Thanks very much, Carolyn. As you said, in normal times, we check every month to see if national job growth is up a little or down a little. It's a key to the economy that actually means a lot for real estate values. But this time, we're in very different territory. Now we can just assess the gigantic job losses that have taken place and get some idea how long this recession will last. A two-step recovery that takes a year or so will preserve real estate values. A much longer one will force a sell-off of homes and depress prices. So let's jump right in. This chart shows the increase or decrease in jobs in the national economy every month compared to the same month of the previous year. In April, those jobs were down 13%. In May, it was 12%. The most notable feature of the May loss is that it wasn't much more. Most observers, me included, thought the loss could be close to 20%. That's because the very large number of claims filed for unemployment benefits. At times like this, the government has difficulty estimating how many people actually have jobs, especially people who work part-time or for themselves. But even if, even if they may be inaccurate, what do the numbers tell us? Most importantly, that this is probably as bad as it gets, a 12 or 13% loss of jobs. That's twice as bad as during the recession of 2008. But the difference now is that we all expect many of those jobs to quickly come back as states begin to reopen their economies. The big unknown is how long the second step of the recovery will take. Most likely, it will be a year or more, and in fact, some of the old jobs will never come back. Let's look at the various sectors of the economy to see why this may be true. Here's jobs in manufacturing. As you see, manufacturing jobs already were in poor shape before the recession. While the pandemic may eventually bring more manufacturing jobs back from abroad, you can bet that US manufacturers already plan how they can use fewer workers, especially in job-intensive businesses like food processing. In construction, there probably will be a sharp rebound, but mainly on existing projects, or for an infrastructure program if Congress will create one. Individuals, companies, and local governments will not push a lot of new projects for quite some time. Retail jobs were already in tough shape because of online shopping, and we are probably seeing a permanent shrinking of brick and mortar stores, which means a permanent loss of jobs. Business services is one of the engines of the economy. As businesses start up again, they need those services, and these jobs will return fairly quickly. That's a big plus for the economy. The situation is more complicated in healthcare. Although hospitals are now considered more important than ever, their financial health has been seriously damaged, and they'll have to streamline their operations, which means fewer people. Finance, on the other hand, one of the most computerized industry, will be little affected by the current situation. This is important for real estate because people with jobs in finance are homeowners. At restaurants, we see the worst of the recession. Note that the scale of the chart is 3 times higher than on the other charts. Almost half of all restaurant jobs lost. The same scale of loss also happened to to hotels and other tourist businesses. It's most likely that far fewer people will visit restaurants and hotels for years to come. Now we get to the sector where the job situation in May was actually worse. Government jobs tend to be stable: teachers, firefighters, police clerks. But local governments have lost vast amounts of revenue in this recession and will have no choice but to cut back their operations. Again, this will last years. And it's bad for real estate because government workers, too, are homeowners. Finally, let's have a quick look at how this recession compares to the last one in 2008. Here's a good way to see them by tracking both jobs and consumer spending. Here's what happened in 2008. The blue bars are retail spending and the red line is jobs. The biggest job loss was 5%. The biggest drop in retail spending was 10%. What I mainly want you to notice is that spending, not jobs, is what drives a recession. Spending picked up at the end of 2009. Jobs didn't recover until well into 2010. Now here's the current recession, which starts off twice as bad. The problem I foresee is that while a good number of jobs will come back by the end of the year, people will not spend lots of money anytime soon. Spending is what we need to track, and new data on spending will come out next week. To finish, I want to plug our two products that are designed for investors in rental property. The Investors Metro Analysis shows you the economic situation in any of 200 metro areas and what that means for investing. How much to pay very specifically tells you the best price to pay for rental property in local zip codes. They're even more useful in times of uncertainty like right now. You can get more information and buy them directly at our website. Thanks for following along. This is our National Economic Outlook. I'm Inga Windsor.